For generations, Lehman Brothers stood as a titan of Wall Street. Its name synonymous with power, ambition, and the very fabric of American finance. Then, in one cataclysmic weekend, it vanished, leaving an indelible scar on the world economy. The story began humbly in 1844. Henry Lehman, a German immigrant, opened a small dry goods store in Montgomery, Alabama. His brothers soon joined, laying the foundation for a family enterprise that would eventually span continents. Recognizing the agricultural heartland around them, the Lehman brothers shrewdly expanded into cotton trading. They acted as middlemen, buying and selling the vital commodity, accumulating significant wealth and establishing their financial acumen early on. Following the Civil War, the firm moved its operations to New York City, the burgeoning financial capital. This strategic relocation allowed them to diversify beyond commodities, venturing into investment banking and becoming a formidable presence on Wall Street. Through the early 20th century, Lehman Brothers solidified its reputation. They financed railroads, infrastructure, and emerging industries, playing a pivotal role in America's industrial growth. Their name became synonymous with financial innovation and influence. After World War II, Lehman Brothers continued its expansion, riding the wave of post-war prosperity. They navigated changing markets, adapting their strategies to remain at the forefront of global finance, ever seeking new opportunities for growth. The 1980s brought an era of aggressive expansion and leveraged buyouts. Lehman Brothers embraced these riskier strategies, pushing boundaries in pursuit of greater profits. This period laid the groundwork for both immense success and future vulnerabilities. Richard Fuld, known as the Gorilla for his tenacity, rose to lead Lehman Brothers. Under his long tenure, the firm became fiercely independent and highly competitive, often taking significant risks to maintain its top-tier status on Wall Street. In the early 2000s, Lehman Brothers, like many others, plunged deeply into the subprime mortgage market. Lenders offered loans to borrowers with poor credit, often with adjustable rates, creating a vast pool of high-risk debt. These subprime mortgages were then bundled together into complex financial products known as mortgage-backed securities, or MBS. They were rated highly by agencies, masking the underlying risk and making them attractive to investors worldwide. For years, the housing market soared, fueled by easy credit and speculative buying. Property values climbed relentlessly, creating a perception of endless growth. Lehman Brothers held billions in these increasingly volatile assets. By 2006 and 2007, cracks began to appear. Homeowners with subprime loans started defaulting as interest rates reset and house prices stalled. The once lucrative MBS market began to show serious signs of strain. In March 2008, investment bank Bear Stearns collapsed, requiring a government-backed rescue. This event sent shockwaves through Wall Street, revealing the fragility of the system and intensifying fears about other exposed institutions. Lehman Brothers found itself holding an enormous portfolio of toxic assets, primarily subprime mortgages and related securities. Their balance sheet was severely strained, and investor confidence plummeted, leading to a desperate search for capital. Throughout the summer of 2008, Lehman executives frantically sought a buyer or a major capital injection. Potential partners like Bank of America and Barclays explored options, but the sheer scale of Lehman's liabilities proved daunting. As the crisis deepened, government officials debated intervention. The Treasury Department and Federal Reserve faced an agonizing choice: bail out another major bank or risk a wider financial meltdown. Moral hazard was a key concern. The weekend of September 13 to 14, 2008, became a desperate marathon. Top financial leaders converged, working through the night to find a solution. But without government backing for a bailout, no private buyer could be found. By Sunday evening, all hope was lost. The government decided against a bailout, citing the need to avoid setting a precedent for other failing institutions. Lehman Brothers was left with no options, facing inevitable collapse. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy in U.S. history, a staggering admission of defeat for a 158-year-old institution. News of the bankruptcy sent shockwaves across global markets. Stock indices plunged, credit markets froze, and fear gripped investors worldwide. The financial system teetered on the brink of total collapse, a terrifying domino effect. Thousands of Lehman employees, many having dedicated their careers to the firm, were suddenly jobless. The scenes of them leaving with their personal effects became an enduring symbol of the human cost of the financial crisis. Lehman's collapse triggered a severe credit crunch. Banks stopped lending to each other, fearing counterparty risk. The contagion quickly spread, threatening major insurance companies, money market funds, and the entire global financial architecture. To prevent a complete systemic meltdown, the U.S. government swiftly enacted the Troubled Asset Relief Program, or TARP. This massive bailout injected hundreds of billions into struggling banks, an unprecedented intervention to stabilize the economy. The Lehman Brothers bankruptcy forever altered the landscape of global finance. It spurred new regulations, like Dodd-Frank, aimed at preventing future collapses. Yet, debates continue about the effectiveness of these reforms and the risks that persist. The fall of Lehman Brothers remains a stark reminder of the interconnectedness and inherent vulnerabilities of the modern financial world. Its shadow continues to influence economic policy and market behavior today.